It was American businessman Scott Cook who once said, "A great generation of Americans will retire in poverty instead of prosperity because they simply are not preparing for retirement now." In this lesson, we're going to calculate future values of retirement investments that are both singular deposit and periodic deposit. We will compare tax savings by making contributions to pre-tax retirement savings accounts, and we will calculate an employer's matching contribution to a retirement account, all to be able to answer the question, how can you save for your retirement? Let's make sure we're ready for this lesson by answering the warm-up question number 2, which is to evaluate each of the following expressions when A is 4, B is 1/2, C is the square root of 2, and D is -2. First up is the quotient AC over BD, all to the second power. This means the numerator is 4 times the square root of 2. The denominator is 1/2 times -2, and this is all raised to the second power. This will give me 4 square root of 2 over -1 to the second power. -1 squared on a denominator is 1, making the denominator go away. 4 squared is 16. The square root of 2 squared is 2, so 16 times 2 is 32. Now we will do D times the square root of C to the A power, which is -2 times the square root of 2 to the 4th power. This will give me -2 times the square root of 2 to the squared power. 2 to the squared power is 4, the square root of 4 being 2, times -2 will give me 4, or -4. Then A times B to the 4th power, where A is 4, B is 1/2, and that to the 4th power. 4 to the 1, or times 1/2 is 2, and 2 to the 4th. Now let's take a look at a problem that you will be able to do by the end of this lesson if you're not even able to do this yet. This is Leo that makes $75,000 per year. His company offers a 401k retirement plan in which they make 50% of his contribution to the 401k up to 6% of his salary. The company allows the employees to make contributions to the 401k to a maximum of 15% of their salary based on IRS contributions, rules that pertain to their particular financial organization. Because Leo is younger than 50, his maximum allowable contribution to a 401k is $18,000. How much should Leo contribute per month in order to maximize his employer's matching contribution? The first thing is to determine the maximum that Leo's employer will allow him to contribute to his yearly 401k. His salary of $75,000 times 15%, or 0.15, gives us $11,250. Now that $11,250 is below the $18,000 that the 401k will allow. If we divide the $11,250 by 12 for his monthly contribution of $937.50, that $937.50 will reach the employer's maximum contribution by the end of the year. But suppose Leo only wants to contribute the amount up to the employer's matching contribution level. He finds 6% of his salary and then divides that by 12. So $75,000 times 6%, or 0.06, to get $4,500. Dividing that by 12, he gets $375. Leo will make a monthly contribution of $375 to his 401k account. Now, his employer will be matching contributions of 3%, which is 50% of his contribution. So $375 times 50%, or 0.5, is $2,250, which divided by 12 is $187.50. So Leo's $375 and the employer's $187.50 means there will be a $562.50 contribution to Leo's retirement every single month, bringing his annual total to $6,750. If you couldn't do this problem just yet, don't worry, you will be able to do it by the end of this lesson. There are specific points in a person's life when he or she stops working, and this is called retirement. People can be partially or semi-retired. That is, they can continue to work a part-time job out of choice or financial necessity. There are many options available that can provide you with some form of income in your retirement. Some retirement accounts are made with pre-tax dollars. A pre-tax investment is a deposit made to a retirement account that is out of your wages before taxes have been calculated and deducted. Pre-tax investments lower your current taxable income. Other types of accounts are made with after-tax investments. This is money that is deducted from your income after taxes have been deducted. An individual retirement account, or IRA, is an account that is opened by an individual. There are two types of IRAs. A traditional IRA is a savings plan in which the income generated by the account is not taxed until it is withdrawn from the account. Money that is not taxed in this way is known as tax deferred. If you withdraw the money from the account before the age of 59 and a half, then you have to pay an early withdrawal penalty of 10% on that amount, as well as income. The penalty can be waived for certain exceptions, such as a qualified higher education expense. The second type of IRA is a Roth IRA. All deposits into a Roth IRA are taxable, but when the money is withdrawn from the account after having been there for at least 5 years and the saver is at least 59 and a half years old, the money and the income earned is tax exempt or free from taxes. There is an income limit to being able to open an IRA. A 401k plan is a retirement savings plan that is sponsored by an employer for its employees. Like other retirement plans, there are strict rules as to when the money can be withdrawn without penalty. There are also contribution limits that can change from year to year. Self-employed professionals can set up individual 401k plans. The SEP IRA plans and Simple IRA plans are retirement saving plans for self-employed professionals. The pre-tax money invested in this type of an account is tax-deferred until it is withdrawn. A 403b plan is a tax-deferred retirement savings program for employees of educational institutions and some nonprofit organizations. Let's start by calculating the future value of a retirement investment that are periodic deposits. Blythe is a 40-year-old. She is planning on retiring in 25 years. She has opened an IRA with an APR of 1.25%, compound monthly. If she makes monthly deposits of $450 to the account, how much will she have in the account when she's ready to retire? To figure this out, we're going to use the formula B is equal to P times 1 plus R over N to the NT power minus 1, all of that divided by R over N, where B is the balance, P is the periodic deposit, R is the rate, N is the number of times interest is compound annually, and T is the time in years. So B is equal to 450 times 1 plus 0.0125 divided by 12 to the 12 times 25 power minus 1, all over 0.0125 divided by 12. To calculate this one, I'm going to be using my Texas Instruments TI-30XS. I'm going to hit the fraction button, 450, parenthesis, 1 plus fraction button, 0.0125, down arrow for the denominator, 12 in the denominator, right arrow, close a parenthesis, fraction, which is the up arrow button, 12 times 25, right arrow to come out of the exponent, minus 1, close the parenthesis that is the numerator. Press the down arrow to get into the denominator, fraction button, and in the numerator, I'm going to put 0.0125, down arrow into the denominator, a 12, and hit enter. This is going to give me approximately $158,200 $377.96. This can also be done in an Excel spreadsheet, and let's take a look at how that would be done now. To do this, we're going to go into the command bar at the top. Hit equal B2 times, open parenthesis, 1 plus B3 divide 100 divide B4, close parenthesis, exponent, which is the up arrow, open parenthesis, B4 times B5, close parenthesis, minus 1, close parenthesis, ending the numerator, divide, open parenthesis, B3 divide 100 divide B4, close parenthesis, ending the denominator, and hit enter. This is going to give us $158,377.96. Let's check our understanding, which will have a greater effect on the financial balance in Blythe's account, half the monthly deposit or half the interest rate. To do this, we are going to go ahead and use that Excel spreadsheet that we have just built. Half the money deposit yields a final balance of $79,188.96, and half the interest rate of 6.25% yields a final balance of $146,077.25. Now, let's compare tax savings by making contributions to a pre-tax retirement account. Suppose Blythe's annual contribution was pre-tax. How much would she save in taxes in 1 year if her taxable income for that year was $72,650? Using a tax table, we can see that Blythe owes $11,874 in taxes. Blythe's contribution of $450 each month times the 12 months the contributions will be made will make $5,400 as the contribution. By using pre-tax dollars for her retirement investment, her income was reduced by $5,400. Had her retirement deductions not been pre-tax dollars, her taxable income would be $5,400 higher. Taxable income plus pre-tax dollars, so $72,650 plus the $5,400 means $78,050. Suppose Blythe's income was $78,050. Using the tax table again, on the right below her taxes would have been $13,035. To find how much Blythe saved, subtract the taxes withheld and the reduction from the tax with the reduction, meaning $13,035 minus $11,847 will give $1,188. By opening up a retirement account by which the retirement savings were pre-tax deferred, Blythe saved $1,188 in taxes. Let's check our understanding of this by supposing that Jacob invested D dollars in after-tax retirement accounts. His taxable income for the year was A dollars. Represent the taxable income had he invested that same amount in pre-tax dollars. Well, his taxable income was A dollars and his tax deductible was D. This means his taxable income would be A minus D as a nice simple equation. Chelsea is 45 years old and she plans to open an IRA. She wants to have $300,000 in the account when she retires at age 62. How much must she deposit each month into an account with an APR of 1.1% to reach her goal? To do this, we're going to use the formula P is equal to B times R over N all over 1 plus R over N to the NT power minus 1 in the denominator, where B is the ending balance, P is the periodic deposit, R is her interest rate, N is the number of times interest is compound annually, and T is the number of years. So P would be equal to 300,000 times 0.011 divided by 12 all over 1 plus 0.011 over 12 to the 12 times 17 power minus 1. Why 17 for years? Well, she's currently 45 years old and plans to retire at 62. So 62 minus 45 is 17. Using the trusty Texas Instruments TI-30XS, we're going to hit the fraction button, 300,000, parenthesis, fraction button, 0.011, down arrow for the 12, right arrow to close that parenthesis, down arrow into the denominator, open a parenthesis, 1 plus fraction button, 0.011, down arrow into the denominator, 12, right arrow out of there, close it, exponent, 12 times 17, right arrow to get out of the exponent, minus 1, and hit enter. This means she will be making a monthly payment of $1,338.04. But we could do this on an Excel spreadsheet, which we'll go ahead and do to see how that works. In the command bar, we are going to put equals B2 times, open parenthesis, B3 divide 100 divide B4, close parenthesis, divide parenthesis parenthesis 1 plus B3 divide 100 divide B4, close parenthesis, up arrow for the exponent, open parenthesis, B4 times B5, close parenthesis, minus 1, close parenthesis, and hit enter. We get $1,338.04. Let's check our understanding by looking at Devin. He is 35 years old. He plans to open an IRA. He wants to have $500,000 in the account when he retires at age 60. How much will he deposit each month into an account with an APR of 1.6% to reach his goal? Now, we've already built an Excel spreadsheet, so we should go ahead and use that. We can simply put in 500,000 into the P, 1.6 as the percent into the rate, 12 for compound monthly, and 25 years for how long he has, which is $1,356.59. Let's extend our understanding here, which would result in the need for a larger monthly deposit, half the interest rate or half the number of years before the money is withdrawn from the account. Going back to the Excel spreadsheet, you can see here that this is 3 times, the original being the top left. Moving over to the right, instead of 1.6% interest, let's put in 0.8. And we get $1,506.11. But if we go down to the one underneath and change the time frame to 12.5 years, we're going to get $3,013.32. Seeing that half the number of years has the greatest effect on what the monthly payment would be. Zander is a 50-year-old married man who files taxes separately from his wife. He has been making monthly contributions into his traditional IRA for many years. Last year, he entered into a new business partnership and decided to withdraw $50,000 from his IRA to make an initial investment into the partnership. Zander's taxable income for the year, excluding the $50,000 from the IRA, was $96,000. How much extra did he pay in both penalty and taxes because of the withdrawal? Using the tax table shown, Zander's taxable income of $96,000 would have him taxed $17,221. Zander's withdrawal will increase the taxable income of $96,000 by $50,000 to a new taxable income of $146,000. Because the taxable income is more than $100,000, he must use a tax computation worksheet to calculate his tax. We can see that $146,000 is less than $160,725. This means he's going to have to multiply it by 24% or 0.25. giving him $35,040. When we subtract the $5,825.50 from the $35,040, we get $29,214.50. $29,214.50 minus $17,221 is $11,993.50. Zander's tax is now $29,214.50, which is $11,993.50 more than if he had not made the early withdrawal from the IRA. Because Zander made a withdrawal before age 59 and a half, he must also pay a penalty of 10% for the withdrawal of the income. 10% times 50,000 is 5,000. $11,993.50 plus that $5,000 means he will be paying $16,993.50. So Zander had to pay $16,993.50 extra in combined taxes and penalties due to his $50,000 withdrawal. Let's check your understanding and suppose that Rachel's taxable income is D dollars. She withdraws A dollars from her IRA, which brings her taxable income between $160,725 and $204,100. Using a tax computation worksheet below, write an algebraic expression for her tax. We know that her amount of income is going to be D plus A, and that she earns over $160,725, but less than $204,100. She's going to be paying 32% tax on this, which means she's going to be paying 0.32 times D plus A minus $18,683.50, because this is a subtract amount in column D. Now let's calculate an employer's matching contribution to a retirement account. We're going to do this and return to a problem from warm-up. Leo makes $75,000 per year. His company offers a 401k retirement plan in which they make a 50% contribution of his contribution to the 401k up to 6% of his salary. The company allows employees to make contributions to the 401k to a maximum of 15% of their salary based on IRS contribution rules that pertain to their particular financial institution. Because Leo is younger than 50, the maximum allowed contribution to a 401k is $18,000. How much should Leo contribute per month in order to maximize his employer's matching contribution? First, we want to determine the maximum that Leo's employer will allow him to contribute to his yearly 401k. This would be $75,000 times 15% or 0.15, which will give us $11,250. Now, Leo can contribute $11,250, which is below the 401k limit of $18,000 for the year. To find the monthly contribution, Leo can divide this number by 12, giving him $937.50 per month. Now, Leo can contribute $937.50 per month and will reach his employer's maximum contribution limit by the end of the year. Suppose Leo only wants to contribute an amount up to the employer's matching contribution level. He finds 6% of his salary and divides that by 12, or $75,000 times 0.06 to get $4,500, and dividing that by 12 gets $375. Leo will make a monthly contribution of $375 to his 401k account. His employer will make matching contributions of 3%, which is 50% of his contribution. So 375 divided by 2 will give us $187.50. So Leo's employer will contribute $187.50 per month, or $2,250 annually, to match Leo's contribution. $375 and $187.50 will give $562.50, each month will be put into Leo's 401k account. The total amount of deposit into his 401k account multiplied by 12 will bring him to $6,750 per year. Let's check your understanding by looking at Robin, that has a salary of $D. Her employer will match her 401 contribution up to P% of her salary. Write an algebraic expression for Robin's monthly contribution if she only wants the total to match the maximum amount that will be matched by her employer. Well, she earns D dollars. They will match P% of her salary, which will give us D times P. The percent as a number would be divided by 100, but it's going to be times 12 for every single month of the year, giving us D times P over 1200 as our algebraic expression.